Why do you think the mainstream media demonizes private credit?
Because it's just done so well. It's in the same way that crypto has its day. The faster you rise, it's always going to just be a natural part of how it functions. And whichever asset class rises the most will be the one to sort of start seeing that. At the cycle, you already have people calling a bubble and a peak. It's natural. That's where it goes, and then that's one of the most interesting things for media.
A lot of people who I talk to are not in private credit. A lot of them will just say, well, this is just unregulated lending to high-risk companies. What do you say to the critics who say, it's no different to unregulated lending that was being done in the early noughties?
I would say that it's hardly a criticism, it's a feature. What private credit is intended to do is to be unregulated and to function in ways that the banks do not. Where you have an issue is when you have ways in which this lending or this asset class or whatever it may be deploys leverage in such a way that it could be a problem to the economy.
Sharif Eid, welcome back to Majlis and Markets.
Thank you so much.
Sharif, I really got you here today to talk about a thing that's really been interesting me the past couple of months is private credit and private markets by extension. Private credit's been a lot in the news recently with the likes of Blue Owl. Jamie Dimon's been commenting a lot. A lot of people talking about a private credit crisis, talking about whether this asset class, will survive. Just to kick off the podcast, how would you currently characterize the global private credit industry right now?
Well, I think we'd have to start. So let's start with a step zero. There's a very important bubble to pop, right, in the conversation about bubbles. And I think it's the idea that you can call bubbles. Just as a start, maybe as a housekeeping item, I think it's very often that with any sector that does particularly well over a period, that you very quickly get, messages and publicity around a bubble that is inevitable, that is systemic, and there's many steps to that conversation, and certainly you can challenge things along the way. But I guess kind of my starting point would be, and I'll just note that this is something that I will not be doing, is making large dramatic forecasts. It's something that very few people remotely have a track record of doing well. So my first warning would just be warned about a lot of these warnings. What tends to be a very attention-seeking is typically nearly impossible to forecast in practice, which is very different than to say whether or not there are concerns in certain markets, right? So I think that is just, I feel an important point to just start with as an idea. But if we, really kind of go down to the market itself and just take stock of what has happened and what it is, it's a form of credit disintermediation that has propagated, around the world in many places. And obviously it's at a much more advanced stage in developed markets than it is in ours, many of which are taking their own path. There are different subsets within the asset class as well. Very often it's too simply spoken about as private credit, but private credit could be direct lending. It could be asset-backed lending. There's emerging markets and they're different than European and US. And, all of those, it's simply too simplistic to just make a claim about the asset class and just say that it's a bubble. So that would kind of be the starting point. And certainly, I don't think you can make the claim, and this you could probably say with some level of certainty, that the asset class is not serving a purpose for both sides, for the borrower and to the lender. So to lenders that know what they're doing and what they're investing in, the asset class has been a really important part of their asset allocation and has performed really well for them. And for borrowers that have known how to take advantage of this, that's clearly been accretive in certain ways, especially where banks and bank lending has receded. So what we know is it's a financial product that has its purposes, served it really well, and has grown a lot. So that is maybe the starting point of the conversation.
But Sharif, there's been a lot of hype around private credit since 2008, especially in the US. It's become, I think, like a $5 or $6 trillion market globally, and it's been growing rapidly in a lot of other geographies. Obviously, it's concentrated heavily in the United States. And you're right, there are different idiosyncratic stories which need to be unpacked. But when the mainstream media like Bloomberg or people like Jamie Dimon and others are commenting on private credit, this kind of shows that it's now completely in the mainstream. It's not, well, excuse the pun, but it's not so private anymore, is it?
No, it's certainly that. No, it's not. It is public, of course, and that's, I think, to your point, that's probably where some of the arguments about it being a systemic risk have come from. That it's become large and noteworthy, where there's an effect that people presume allow it to have an impact on other markets, right? So that is certainly the starting point. Just though, the one thing I will say is, kind of to the point of the estimates of the size of the market, and you'll hear a variety of them, and mention the 5 trillion number, which is a common one. But even within that, I think it's just worth making a few nuances. And I think it's not something that we'll want to spend, too much time or getting too much into the weeds of, but the market's arguably even much larger. So there's probably, somewhere around 2 trillion in direct lending. The larger space of funds is probably closer to 5, as you mentioned. But if you include a lot of the broader definition of what would be within private credit, such as a lot of investment grade asset-backed securities, for example, the number has been estimated to be even larger, potentially as large as 40 trillion. This is all just to kind of come back to the first point that there is a worthwhile degree of nuance within that. But I would believe, I'll take the leap here to say that when most people think of private credit and they think of it in the context of what the headlines are saying, which is an asset class that's not doing well, what they're specifically referring to is the part of the market that is largely direct lending and largely non-investment grade. So that subset kind of brings you down to what most people refer to, and that's where kind of stories like you mentioned, Blue Owl, etc., where a lot of the software type lending, for example, would be kind of within that subset.
Interesting. One of the things that a lot of people have been talking about is, well, there's a number of things. So the first thing is liquidity in a lot of things like direct lending,
Yes.
private credit funds. I was at the Abu Dhabi Finance Week's private credit event, which was held in December, and there were a lot of high-profile people like Ted Koenig from Monroe Capital, who we've had on the show, and we've had other people as well in the private credit space, and a lot of them were saying that 2026 would be a very difficult year. Obviously we didn't know that the Iran conflict would take place and all these other things would take place, but they were talking a lot about things like liquidity. Yes. Why do you think a lot of people are talking about liquidity right now in this market?
Largely, I think they seem to have a fundamental misunderstanding of the asset class, because by its nature, the word private that started at the beginning implies no liquidity. So let's take a small step back, because I think, again, there's sort of a series of issues. So there's the asset class, right? So the underlying product, where there's potentially asset quality. The answer could be yes or not. And then there could be the vehicle, right? So what it does, what it's intended, and what people were sold. And then there's also, what the vehicle is focused on, right? So there's multiple layers to it. And I think each of them probably warrant a little bit of a discussion. But let's, kind of take the first point and let's just, say asset quality as a broad sector. So if we're going to say, look, the asset class itself, or all the managers in the asset class have run amok, they've raised, trillions of dollars apparently, and it's all gone to bad lending. You would expect to see that in some data. And just again, respectfully to a lot of the headlines that we see, they tend to often be that, a problem is coming, etc. But the reality is today, we don't see that in the data. So a lot of the indices that track kind of these default or performance data are not showing particularly alarming numbers. And probably the most popular of that would be the Proskauer index, where, the most recent figure, which I believe was in Q4, somewhere around a 2.5% default rate. Now, there's a lot of methodology behind that, and people will get into, the use of PIC, etc. So there is a lot under the hood, which I don't want to unpack here today, but just to say the numbers as they are today, and, even across the funds in terms of actual defaults and losses remain low, but they have risen from previous numbers, which were historically incredibly low. So what has just happened, which is very normal at a later stage of the cycle, is we're starting to see the early stages of a normalization of default rate. This does not necessarily mean that it cannot go higher. I'm not making that claim, but what I am saying is there's no obvious reason to make that claim. So for anyone that wants to make that claim, you have to back it by some data, which then brings us to kind of the other point. So if the industry is large enough and systemic, which arguably it is, it's probably representative of the economy as a whole, or certainly the economies where it's widely disseminated. And if you look in aggregate at the United States economy, for example, aggregate corporate lending has not risen in a decade. Investment grade has not either. So you don't have a large-scale leverage cycle ongoing in the corporate sector to begin with. So you have an economy that's doing okay. No leverage in particular on the corporate side, which is causing trouble. And then within the subset of the asset class itself, you're not seeing a deterioration, obviously, in the data to make these claims. And those are just, kind of the basic building blocks to making a very large claim about the sector as a whole. Now, within the sectors, right? So then you can kind of get to another point, and I think we'll get to liquidity last, because it's almost, it follows from everything. So then you get to where some of the noise, and Blue Owl is a good example, where people are very concerned about software lending or any other subset here. And here I'll go back to one of our first housekeeping items around trying to predict bubbles. I don't think we have the time and energy on this single podcast to cover everything from the impact of AI on SaaS and whether SaaS will exist and what type of SaaS companies will exist or not. But I think what we can do is encourage everybody to take a step back and kind of realize that these are very, very difficult claims to make. So if we're going to make claims about, whether it's asset class deterioration, a subset within software, and the impact of AI, you're making a lot of claims to arrive at the conclusions of where these are. And I'm not certainly making the claim that it's not the case. I don't know better, and I'm not an expert in software, certainly. But I think kind of to the point is, where are we seeing actual tangible problems? To me, it's not so obvious. And we could still see some funds, particularly, for example, let's take software as a continued example. It may be the case that you have an elevated default cycle within software. We've had that in the past. The commodity bust cycle, so 2014 we mentioned, that caused credit pressure in the energy and E&P space, right? It didn't blow up an entire credit market. That could happen, and it could happen to a fund or two or many. It won't wipe out the asset class. But then I think I took a very long-winded way to come to your actual question around liquidity, but I felt it was necessary as background.
No, we'll get on to liquidity, because actually just thinking in my head, I want to just take a step back and I think I asked you this on the last time. Private credit itself, Sharif, it's grown a lot from what I've been reading, because, bank lending is a lot tighter. There's a lot more restrictions on banks. So, their risk profile is a lot different now compared to what it was in 2008 and 9. And, to me, this explosion in private credit has been partly down to the fact a lot of mid-market companies in America have been going to private credit lenders, alternative lenders, instead of banks for funding and financing. And it's gone to other things as well, like you mentioned, tech and stuff. But why, you've talked a lot just now about asset quality. For our listeners and viewers, what do you mean by asset quality? Do you mean the underlying credit quality of some of these lendees?
Correct. Yeah. So we're talking about the actual performance of these underlying loans. How many companies would have, defaulted, or actual losses that have been undertaken on these investments.
And the majority, would you say, a lot of these companies are like mid-markets or other companies, that don't have $1 billion turnover and own that kind of smaller mid-sized spot where they're not making big profits at the moment?
Correct. That would be typical. I mean, the industry has been migrating upwards by size. So there's been a lot more happening in particularly in the US with investments that are a lot larger. So a lot of these private credit firms now, for example, do data centers. So those are obviously multi-billion-dollar investments. So the space is evolving, and managers are evolving, and they're doing a lot. But to answer your question, yes, the basic premise of where credit was born, and I think generally the bread and butter, is that it is the financing of SMEs largely, but a lot of middle market. And then in certain places and regions, there's been increasing focus. So, for example, the US, again, it's been a very sponsor-led market. And what we mean by that is it's supportive of private equity activity. So whether private equity purchases or that kind of activity, that's been an origination engine for private credit. So it's by its nature tended to fit gaps where they exist in credit dissemination, and there's specializations that are different in different places. We do something slightly different here. For example, we don't have a sponsored market, but we still have private credit funds and GPs, right, that do that same form of lending.
Just on this point of mid-markets, right, you mentioned just now that the US economy seems to be doing well. By all indications, that if you look at the S&P 500, 7 out of the 400 of the 500 companies are actually, I think maybe more than 40-50% of this entire index, right? Maybe more. I'll check the facts later. But you've got 493 companies. Does that mean that all these American firms are doing well? And that, what I'm trying to get at is that, if these companies are struggling in the real economy, doesn't this lead to a problem with their lenders in private credit?
It could, but let me just dissect what you said for a second. So let's separate 2 points, which is market performance and then real world performance, so economic. The phenomenon that you're talking about, which is kind of the concentration of returns, this is a market-based phenomenon. It's something that's attributed recently to technology and the Mag 7, but it's actually been a consistent feature of markets for 100 years. If you go back to the S&P 500, as far back as data have it, we have many episodes, and in fact, over that entire period, almost all returns accrue to a very small subset of companies. So this is more of a market structure question, which is very interesting in and of itself, but doesn't necessarily tell you much about how the economy has performed, which the economy has performed pretty well. So what we are not saying, right, to just kind of be clear, that within the entirety of middle market that value accrues evenly. That's entirely untrue, right? Actually, it's sort of one of the features or bugs that you want to say of our modern economy and capitalist model. Wealth tends to concentrate and gains tend to concentrate in companies. But that doesn't mean that you cannot lend to the rest of the economy, which performs and grows. Now, there's a much higher incidence of default rates in smaller companies than higher ones. This is natural. But I would just want to say, particularly in credit, you can extract a lot of credit value in a lot of investments without the equity value accretion being identical. Frankly, to that point, it's one of the more attractive features that we think within the asset class, which is why people are drawn to it, that you can extract value from a much larger part of the ecosystem without necessarily having to do exactly as you said, which is pick extreme winners, which is what equity investing requires.
Just tied to that, I remember writing an essay back in my university days in 2007-8 when the financial crisis was going, and this phenomenon of shadow banking in China. And I mentioned that because like a lot of people who I talk to are not in private credit. A lot of them will just say, well, this is just unregulated bank lending or unregulated lending to high risk companies. What do you say to the critics who say like, it's no different to unregulated lending that was done in the early noughties and in places like China and India?
I would say that it's hardly a criticism. It's a feature. What private credit is intended to do is to be unregulated and to function in ways that the banks do not. Where you have an issue with kind of, let's say, that broad categorization of shadow lending is when you have ways in which this lending or this asset class or whatever it may be deploys leverage in such a way that it could be a problem to the economy. Right. So, so let's kind of go back to one of the data points that we mentioned earlier is just, aggregate corporate leverage. So if the leverage doesn't exist on aggregate, so that's kind of one starting point to say clearly there isn't a problem. And the issue with China and shadow lending, as you mentioned, it was primarily, so the first issue is that you had a case of excess leverage. And then where did the excess leverage come from? And then how did it link to the economy? And a lot of times I think we tend to forget that with some of these issues, 2008 was a very good example of this as well. The problem that you have with a lot of these is when a lot of leverage is deployed and you have an asset class that blows up or deteriorates or even just loses value, you get a deleveraging cycle that causes the very long-term pain that we see over a period of time. So here, I think you would need two things to apply this similarly to the case here. Is one, you would need leverage to be excessive, which we don't have. And then you would need the asset class to be highly levered, which is also untrue. So at the moment today, even if you have, so let's say, kind of take the aggregate of the direct lending market, right? It's 1 to 2 trillion, whatever the number is, and assume that performance is actually horrible, and we're going to lose 20 to 30% of these assets, right? Those losses that will mitigate will be a couple of $100 billion, which is very high. So it's a big sum, but across the pool of assets of all pensions and investors, etc., it's not materially systemic, right? So it's kind of bring to that point. This is very different than when the banking sector in aggregate is over levered and needs to go through a period of deleveraging, which is what happened in the US in 2008. And there's, kind of arguments to it, about China being over levered. Again, these are very, attention attracting points. Obviously, deleveraging cycles are very painful. So they don't come from a wrong place. We should be very worried about prospects of deleveraging cycles, but their application is just not uniform. Not every form of lending that is unregulated is obviously bad. Lending itself is not necessarily bad, but excess lending, with bad underwriting, and high potential for mitigation through an economy through other forms of leverage can become problematic. But there's no strong piece for that yet.
Yeah, BDCs, business development companies, right? If they're listed on an exchange where retail investors can get involved, isn't this like what's led to a lot of panic in the market at the moment? Is that
Exactly.
once you get retail involved and it's a public thing, this can lead to a lot of things like liquidity challenges or questions about transparency and things like that and asset quality. Doesn't this lead to the heart of what's going on right now?
It does. So it leads to everything that you mentioned without asset quality. So it doesn't necessarily say anything about asset quality, I should say, right? It may or it may not, but you could have an issue with liquidity that is separate than asset quality. You could have a completely well-performing pool of assets that is not liquid, but is sold in a wrapper that is seemingly liquid, and that wrapper could have a liquidity issue, right? So that is totally fair. So if you want to narrow down the criticism to the point of, BDCs and the variety of transmission vehicles for private credit to retail in a semi-liquid format, was that a bad idea? The answer may be yes. I'm not sure. I think it's a little bit early. I don't think you would ever want to judge a product or an investment purely on one downturn. I mean, I don't know. This is probably not something most viewers know, but in investment trusts, kind of the idea of pooling investors started in the 1920s, and the initial format of it actually went horribly wrong. These trusts were put together. Many deployed excessive leverage. They were sold badly. A lot of people lost a lot of money at the time. Was the idea of the investment trust completely blown? It wasn't. I think, financial innovation in and of itself tends to ebb and flow. And I think there's two parts of this conversation to balance. Is one, is there an advantage of offering these products to investors that don't have access? I think there's an argument to say yes. You shouldn't necessarily exclude every investment purely by the nature. And look, and I can speak, speaking for myself, we are on a closed-ended private credit fund, and I can surely tell you that it is not suitable for every investor type. There's complexity to a closed-ended fund. Sure, it doesn't run into liquidity issues. It's the most appropriate way for the asset class, but it does lock out a lot of other investors. And I think the idea of these of BDCs, of semi-liquid funds, of tender funds, whatever you want to call kind of the larger group, I think came from an idea of broadening out the distribution base and allowing retail investors to invest. And maybe the middle ground would be to regulate them better, maybe to have better liquidity, and to pick an evolution of the type. So I will put, if I had to put my vote, I don't think the structure itself is broken. I think maybe some of its application and some of the ways it was sold would be, but I will wager that it will survive. And I think as a subset, you'll probably actually see it grow over time.
It's just interesting to see open-ended private credit funds on a public market or in an ETF format, where retail investors probably don't even look at the details of what they're actually investing in, and they just want to look at the returns, right? So it's like you said, it's not for every investor to invest in these kind of instruments.
No, it certainly isn't. But neither are zero-day options, the use of which has grown, right? So I think we can, as participants in the industry, we should be the first to take criticism that a lot of times risk is mispackaged or missold and put in the hands of investors too quickly. That is certainly a feature of markets and products and how they function. I don't think that's something that's very easy or will ever be fully taken away, right? I think that's just going to always be a nature of it. I think there's a degree of responsibility on every manager to make sure the products that they sell are well labeled, well regulated if they are. And at any point, just with the right disclosures. But over time, even for the managers now, by the way, even the BDCs that they have now, is I think over the period, if they end up performing as promised, I think you'll also see the other end, and people will forgive this period in time, which seems a little bit more painful than it may end up.
I go back to this point about liquidity, because the most important thing in any kind of financial market is liquidity. You need buyers and sellers, and the private credit industry got headlines recently with the likes of Blue Owl, which I think stopped redemptions, because there was a bit of a redemptions flurry of investors wanting to get out of this. What do you think led to this panic and a lot of these kind of funds that were being done?
I think it's largely been the news cycle, frankly, which is understandable, right? Particularly for a name like Blue Owl, and I do sympathize as well, to a degree with the investor base that's largely retail, is as they see these stories which are discussing fairly complex materials, right? And in the case of, again, kind of Blue Owl, not to pick on them, but they've just been the name.
Blackrock as well, isn't there, right? Blackrock and Apollo and all these guys.
Everybody suffered then a wave of redemptions as a result of this, and it's because headlines came up. People that were wondering, always think of, safety first at times like this. And it is natural. But just to go to it, so where the redemption pressures are coming are within these vehicles, right? Net of, kind of how these managers are doing in general, they are doing fine. Right. And I think some are doing better than others depending on their mix of product. But I want to just come to something, Hassan, is, when we talk about the importance of liquidity, it's an incredibly important point when you want it, right? This is sort of key. And you're right. The asset class here was largely built on the idea that for investors that do not need it. That is where it is best suited. It's for someone who is willing to trade that, because look, at the end of the day, you get paid to make an investment in a variety of ways. There's obviously the risk of the investment, there's the horizon of the investment, there's the liquidity of the investment, so on and so forth. And this is just one of those factors that you need to trade away for a price. And if you're trading it away for a fair price, then it's just as much of a variable as anything. And it's like saying, it's not like, they got their name, just because it was early, but junk bonds are not junk. For the right price, a junk bond could be better investment than investment grade bond, right? What is higher risk? And I'm going to give you an example. Would you buy, an Abu Dhabi government or a Saudi government bond at a minus 2% yield, or a high yielding private credit at 15? So risk is relative to also what you're paying and the investment and kind of how it works. Private credit really boomed in the period where it did very well in being overcompensating for the risk, right? And that's natural for a new asset class. We see a lot of that in the region here. That's a lot of the dynamic. As it grows and it disseminates and it becomes larger, that first mover advantage or that kind of excess alpha starts to diminish a little, right? Just from a broad perspective. But again, all of these are natural progression steps for an asset class that grows. None of this is something which I see an obvious point of alarm.
Why do you think the mainstream media then demonizes private credit?
Because it's just done so well. It's in the same way that crypto has its day, the faster you rise, it's always going to just be a natural part of how it functions. And whichever asset class, rises the most will be the one to sort of, start seeing that. And then we saw, even AI, and we're arguably 3 years into, one of the most important technological transformations of our time as a species. And 3 years into the cycle, you already have people calling a bubble and a peak, right? It's natural, that's where it goes. And then that's, one of the most interesting things for media. So that's never going to go away. So I think, private credit is going to continue to get its fair share of that publicity for a little while longer. But that's probably in some ways, frankly, a reflection of how well it's done and the interest people have in it.
Just want to shift gears a little bit and talk about the GCC and what's going on at the moment in light of the war in Iran. I was just telling you offline, I was reading an article about Gulf sovereign wealth funds and Gulf entities. They've done really well. Even in a time when you think, there's a war going on and activities are stopping, sovereign wealth funds are actually ramping up their private credit activities. I think Mubadala is doing a lot, and others as well are doing a lot. Why do you think there's such a big interest in private credit in this region?
Well, as for that type of investor, right, to kind of come back to, right to the last point that we have, a lot of their investment horizons are very long, and they don't tend to place a very high value on liquidity for a big part of the portfolio. So it's very natural for them to be large participants in private markets in general, right? That's kind of the starting point. And that's why historically they always have been. They've been big investors in private credit and private equity. I think private credit benefits a little bit from it being just kind of earlier in the allocation cycle. And that's across the board, by the way. We see that in the region. The sovereign wealth funds are better. They're further along, I should say, kind of that allocation process. Family offices are now catching up. But it's a very natural way for investors with long-term horizons, which describes a significant part of the wealth in the GCC, sovereign and private, and an allocation cycle that's very early, barring very few notable exceptions within institutional or private money that we speak to, where their overall allocations to private credit is something that they would deem sufficient or excessive or needs reduction. Almost across the board, there's an interest to look at, and there's an interest to grow.
Yeah, it seems like it's more of like a diversification play, right? They don't want to just be involved in public markets. They want to look at everything holistically rather than just focusing on, US equities or whatever, right?
Exactly right. And there's this, an added element to it, which within the world of income generating assets, one obvious subset of that is obviously real estate. The region tends to be very well allocated. It's in fact over allocated to real estate. And then it leaves, the broad world of fixed income, which is something that they're also under invested in general. But the recent changes in the dynamics of markets, kind of the last 5 years, has meant fixed income and bonds and treasuries in particular have become a lot more volatile than they've been in the past. And their correlation to equities has also changed from being negatively correlated as it was, and having a portfolio diversification advantage. So those have also been factors that have made private credit more attractive. Kind of the idea was if you're going to get income generating product, you over allocate it to real estate, you start looking within the fixed income space. Private credit within that as a subset, has become even more attractive in kind of the post-COVID era.
How and why, or what opportunities is the Iran conflict creating in the private credit space or within the asset classes?
Well, speaking specifically for the region, which is sort of where I operate and my expertise, but to be honest, Hassan, as of the time of this conversation, I guess just to kind of mark it in time, the impact has so far been on aggregate relatively muted, I would say, and there's a relative bifurcation within the market. There are big subsets which are largely unaffected, and here you would bucket something like Saudi Arabia for obvious reasons. It's not as dependent on the strait, was not as directly impacted, and is a lot more domestic focused. So with a lot of the portfolio companies that we deal with in Saudi, it's frankly been almost business as usual as far as we can tell so far, with some disruption certainly, but nothing dramatic. You come to the UAE, you get a much more diverse story. Obviously, there are many parts that are very tourism dependent or entertainment dependent. Those are severely impacted, and then you have a lot of other subsets which are a lot more resident dependent, which have done pretty well. I would say the impression so far is that I think certainly the region on aggregate has done better than I think would have been expected given the situation. Within the areas that are most affected, I think probably the most high profile would be Dubai as a headline, which again, kind of, to the same point of private credit, the faster you rise, the more likely people are to just look to point flaws. I think the resident population in Dubai and things that are resident independent so far have held up better than people expected. And to that point of, what would happen in this situation, how many people would leave, what would happen to the population. So far, the impact seems relatively muted. There's certainly some loss of population. Obviously, tourism is down significantly. So a lot of the businesses dependent on that. We'll only know the outcome, I think, eventually with time. And to a degree, a lot of that is just unfortunately going to be out of their control. And we'll see, where the government balances out. But to kind of, just wrap up, I think in aggregate, I think things seem to be performing well. Public markets, equities have done fairly well actually. In some places like Saudi, the market's actually higher. Within fixed income, public fixed income, kind of being away from fixed income, there are some areas where spreads are a little bit wider, but there's been a particularly notable impact on Dubai developers. Again, you can kind of see that the trend has been that there's this subset, relatively Dubai related, kind of tourism heavy, that has taken the brunt of the damage, with everything else seemingly relatively well contained.
You mentioned Saudi Arabia, and I wrote an article, which I'll link in the show notes, that, despite the conflict that's going on, Saudi Arabia's equity market, as you've just said, has done really well, and it's still got quite a big listings pipeline despite the conflict. And, investors seem quite bullish on Saudi Arabian equities, albeit that a lot of them are still local, although foreigners are getting involved as well. But I mentioned that a lot of your portfolio companies, or some of your portfolio companies, are in KSA. Would you say the development of the local capital market, so I'm thinking of things like Nomu, I'm thinking of things like other mid-market firms in Saudi, which there are a lot actually, is playing a role in the opportunities for investing in mid-market companies in this region?
Well, I'll tell you what, without needing to, maybe speak about an area which I'm not purely focused on, kind of on the equity side, what I can say is I think there is we're on the precipice of a positive flywheel of the interaction of these capital markets. So from where I sit, I can tell you what it is that I see, which we're very excited about. The pace of development of companies in the private space is really, really very impressive. We're seeing a lot of great companies grow at pretty fast rates, and I think the often touted pipeline of IPO companies to come is really starting to form. A lot of the companies that are reaching the right scale, that are reaching the right profitability, that are making the right turns in their performance, are going to make exceptionally good candidates. And I think as you get a few that do come, do perform well. They will, open opportunity for others, and it'll be a positive cycle. Most important of which is going to be that I think a lot of these are going to introduce relatively new sectors, which is probably the most exciting part. I think seeing more tech companies, more fintechs, more of the new age economy, which a lot of people want to see, come to the markets is only going to be positive. And then that comes back to us in private markets, right? Because as exit paths become more clear, see more equity going to the private markets, and then more debt will follow kind of from private credit, and then that's sort of ultimately that's probably what was the intent with a lot of the capital market reform agendas that were in place. It's how do they seed the right opportunities to see them grow through the cycle so that it becomes self-sustaining. And I do think we're at a very interesting inflection point for that.
Sharif, I wrote an article at the beginning of this year looking at Abu Dhabi. Abu Dhabi's been doing a lot in terms of establishing itself as a hub for private credit in this region. It established its private credit regime in 2023, I believe, for private credit funds operating within ADGM, which is the Emirates Financial Free Zone. I'll link it in the show notes, the article that I wrote. And one thing that got me thinking was that, this region generally historically has been seen as capital deployers, like deploying capital outside of the region due to the sovereign wealth funds or oil windfall, all that stuff. But would you see, or do you envisage like a local homegrown pipeline of companies for private credit lenders in the coming years?
I'm adamant that that's the case. Yes. I think you're at a point now where the type of opportunities and what we're seeing is going to create successes that will certainly make that the case in the near future. I think the only thing standing in the way now, particularly for large allocators, is the ability to deploy at scale, and it's just natural, right? Like, the market is going through the transition. So at the moment, we sit sort of at an interesting place between a very interesting opportunity set and those best suited to take advantage of it needed to be a little bit larger to get involved. But I think these things resolve themselves with time because, people are interested, and we do see continued interest in the space. We haven't seen a lot of deterioration in interest, as far as we're concerned, from clients and pipeline we've been working with, despite what has happened. And I think it just speaks to the the obvious idiosyncratic nature of the opportunity set. It's not very beta driven. It's a very unsaturated market. And I think considering what has happened, if to the question earlier, actually, one point is probably worth mentioning is, I think one of the potential impacts of what has happened, more so than on the economic side, but on the capital side, is you may have a slight deterioration even in what was already a bad situation. There was a dearth of capital to begin with. If you get a retreat from what few managers there were, it just improves the opportunity set for people who are dedicated. But ultimately, like I said, I think, good companies still get funded. There's always a way that they do. And as you have multiple funds go through this vintage and do well, it'll also just make the case for the asset class. So I think, for everyone involved, it just becomes increasingly interested. And you need big successes, right? So you've had early investors in the likes of Dhabi and Tamara, so these people seeing an exit, seeing the capital come back, will incentivize more stories. And there's more to come.
A lot of the Gulf countries have been putting stimulus within their financial system. So do you think as bank liquidity, albeit it's coming tighter, do you think like a lot of companies will be looking for alternative lending, like private credit and these kind of other non-conventional ways?
Very, very, very much so. And not just for, I want to say, so to your point, I think certainly for places where, they look for capital and can't find it. But I think where you'll also start seeing is innovative uses of capital. Right. So, one of the things that private credit does well, I think we focused a lot on some of the negatives, but is in providing capital that is either bespoke, can serve a very unique purpose. For example, you take a lot of these large companies as they grow and near their IPO stages, funding that's, friendly for pre-IPO. There's a lot of places here that dedicated and good private credit can serve a very distinct purpose. So I think you certainly will see that. So for a combination of, some will simply be the type of credit that banks don't want to do, and some of it will be just, kind of new and innovative uses that these corporates will start to using. Clearly when they're growing so well, right? This is kind of always an interesting point, is that, yes, capital can be a little bit expensive, but, for companies that are growing very well, very fast, where they're seeing a lot of value in their business and they have a lot of potential, the pricing becomes a less sensitive discussion. And we're seeing more and more of those. We're very excited about the opportunity.
One thing that just came to my mind is, this article that I wrote about Abu Dhabi. I asked Monroe Capital, are you doing this to help facilitate origination? Are you looking to originate deals out of Abu Dhabi and the UAE by extension? And their response to me and others as well I spoke to said, look, we're doing this as a relationship building exercise to begin with. What do you think it will take for the likes of Abu Dhabi and other places to attract, those international private credit managers to, underwrite deals and to provide capital to some of these local companies?
That's a good question. To be honest, I would probably say the best thing to attract managers eventually will just be the opportunity set itself. And that's often still the case. International managers, when and I'm, you could accuse me of being a little bit biased as a local manager, but when the incentive to invest is purely, let's say, kind of in a form of an obligation, that's a very good way to obviously, guarantee kind of investments. But what you really want is genuine interest in the economy and in the opportunity set. So I think that's always a very good starting point. And frankly, if you're a sovereign wealth fund and you're allocating anyways, it's obviously, an advantage to do it. But I think where there's, generally been more mileage is in cases where, the opportunity itself becomes attractive. And I think a lot of things are being done for that. And the examples of it would be reform around regulations for fintechs, and kind of the range of it, right? And everything that's creating these companies that are so interesting to invest in would probably, just multiply itself much larger than in some of these other ways.
You don't think there's any kind of mistrust of previous experiments, like the one that comes to my mind? I know it wasn't private credit, but Abraaj, that caused a lot of trust issues with local companies. Do you think that's been like that's water under the bridge now?
I think people in the private equity industry would probably tell you it's not water under the bridge. That really had damage to that industry. But I do think, for what it's worth, that is seen as a firm-specific issue. That it hasn't been a case that you had widespread fraud across local GPs. That certainly has not been the case. And generally, kind of performance across managers. I can certainly say within credit, a lot of the firms that have been around for a while have done well. So that there isn't a broad base of issue of trust and gross negligence and fraud. Certainly that is far from the way you would characterize the region. But what you had is obviously a case of one bad manager, which can happen. That's certainly always the case. But I think now there's been enough time to show that that's been fairly idiosyncratic. Actually, the region in a lot of ways operates a lot on trust and implicit credit. People take debt here very seriously, and we've had, to be fair, one thing to point that I think is not directly relevant to that, but is sort of a secondary point to it, is what we've suffered from before was a lack of data. So to that point, I think, and it perhaps allowed certain governance issues in certain places where you had the region which was, and there's a lot of reasons for it. A lot of emerging markets happen to would have similar issues, but the region didn't have, tax regimes until very recently, VAT, general reporting. So, ability to get good data around companies to invest in was very hard. That has changed a lot. Right. And one of actually the most interesting things about the space that we're operating in now is that has changed in a fundamental way. And it's been more so the case for fintechs. And it's not coincidentally that that's been one of the major growth sectors, right? Just the advent of technology and availability of data and the ability to act very quickly has allowed these places to receive credit in a way that wasn't possible before, and for that growth to come. So I think all of these stories are forming well for credit in the region, in ways that we're getting past a lot of these common issues, and we get them very often of how do you trust data, how do you trust disclosures by companies, how do you trust numbers that are reported. A lot of that is changing very, very quickly. And there's a lot that even we're deploying, but just kind of your ability to deploy technology in the way that you oversee deals, particularly asset-backed lending deals. Now with the advancement of open banking, which allows you through access to bank accounts and data, which you can monitor on a live basis. That entire premise is moving at such a tremendously fast pace that that really major gap is going to change very quickly.
Yeah, I always say, like, if you want to look at this region, look at it in context. Like, if you compare it to like a decade ago, the region's come a really, really long way in things like you've just mentioned, right? Like about data, transparency, all these things has come a long way. Still a work in progress, but I think it's come from where it was like a decade or two ago. It's a much better place now.
I mean, even if you purely just look at kind of the pre-COVID period, it's very much transformed, and a lot of these have come around this, and it's great to see kind of the region utilizing these advancements of technologies in a certain way. We're not, to be fair, and we should kind of take stock of this, is obviously the region is not a producer of the technology, right? So we're not a major beneficiary of kind of AI just in terms of its inception as a piece of infrastructure. But in terms of its application, sovereigns are obviously, doing quite a bit in investing in the data center space, but companies are using a lot of what has been enabled by this technology to solve local problems very, very well.
Yeah, that's true. We spoke to a gentleman last year who was working from a Chinese AI company with the Saudi Sovereign Wealth Fund, and he was saying that it had to take into consideration like local complexities and local culture, customs, language, all these kind of things. One thing I want to talk to you about as well, which is close to your heart and close to my heart, is Sukuk. And I talked to you this on the last episode, was the opportunities for private credit and Sukuk. Do you still hold this view that private credit can play a role in high yield Sukuk?
I think it can hold a fundamental role within it, and by its very nature, a lot of what you can do, and here I say can obviously because private credit is bespoke and you can do whatever you want with it, but the ability to create bespoke financing that's very tailored to the opportunity, where risk is very explicitly shared, is actually extremely Sharia compliant. To me, I look at a lot of what we do, particularly within the asset-backed lending space, where you actually have a true sale of assets, a real identification of the purpose that this financing is going towards, can achieve a much closer level of Sharia compliance than I think is possible. Some of the criticism that the public Sukuk market has at times is, where disclosures may be a little bit weaker, or where packages may not be as clear, or where generally there's some lack of transparency. And it is a little bit difficult when you have a very large, a very commoditized market to achieve the same level, right? And I think here there's obviously, a lot of levels of interpretation, but I think you can generally see that actually, but the nature of a Sukuk, if it's going to be a truly risk-sharing product, is ultimately for it to be a hybrid between equity and traditionally what we think of fixed income. And you really can create that within private credit. We very largely look at, kind of the way we think of our fund as one that is based on, opportunities of lending specifically against pool of assets and secured. But a lot of times where we have, not just very strong participation in the underlying assets, but a lot of times you have participation in the upside of the company, whether that through some equity link trigger, right? And that serves multiple purposes. Is obviously one, it creates very strong alignment, which is something that you want. So you want to be aligned with the company that you do. The traditional view of the lender, simply being the merchant of Venice, is not one that's appropriate, in my opinion, for the type of lending and the companies that we do. You do want to partner with the company that you have, and you want to share with the risk. And similarly, there should be some sharing of the upside. But also, we're not an equity investor. So, the hybrid model really, really kind of works really well. And if you just kind of tie it back, you made a point earlier that's a very good one about value being, accretion coming down to very small companies, just kind of by the nature of capitalism. A model like this also works really well for the asset class, because, what you want is over a pool of assets that you invested in, or a pool of companies where you have small participation in a set of these, some subset of which can do extremely well. So it does a lot, I think, for product design, and I think it'll prove itself. And then I hope it just becomes a, very interesting subset of income generating assets for Sharia-compliant investors, which, as just have a very limited opportunity set in what they can invest in.
Yeah, it sounds like you're saying that private credit can, have more skin in the game if you're, you want the company to do well, or the issuer to do well, not just look at the return that it gets.
Correct. Oh, absolutely. It should be, and I think also the nature of the asset class and the investor being a committed longer-term investor, kind of by the nature of when you give these financings, you're intended to see them through maturity, also create a very different profile than what public investments are supposed to do, right? A Sukuk that's publicly traded is intended to be traded. The investor holding it on day one is not going to be the one at maturity. what a lot of these financings would do, they would hold you to maturity. So you do kind of see a much closer relation with the company, and again, kind of just a stronger alignment.
How do you've worked at Franklin Templeton on the buy side, and now you're working at Amwal Capital Partners in the private credit. How would you approach Sukuk, from now being on the more, I would say, I don't want to call it lending side, but the more capital providing side? How do you look at it when you get involved in something like that?
Well, we do look at strong partnerships with companies. So, with some that, as a starting point, where this fund comes from and what we're looking to do, comes from a thesis. It's a thesis that we have about the region that it's undergoing very, very interesting and tremendous change. It's a region that also has, very ironically, for being an exporter of capital, has also, has seen companies and, SMEs in general being starved of credit, but also where there's an area within that is extremely lendable. And all of those, sort of lend themselves to, coming back to the conclusion that we had, in the right places, dissemination of credit within the region being done well, has been an extremely interesting investment. And there's a lot of areas for it, but just to, kind of maybe highlight one of the more interesting ones, because we have mentioned it. If you think of the, the rise of fintechs have largely benefited from being regional and localized. And that does really well because you have to be very localized in a very regulated market. And this is why when you take buy now, pay later as a very good example, the largest examples here are locally grown businesses. And that's not a coincidence. That's because they grew within the regulations in the industry. And that is very different from a lot of other technology. I mean, let's kind of go back to AI because we mentioned it, where you do have a concentration of winners. It's going to be nearly impossible for a startup tomorrow to simply, outdo Anthropic or OpenAI. But it's not the case for a local fintech to start a specific product focused on the region, tailored to the region's regulatory regime, right? So you will have extremely large winners within the space that operate within industries that are regulated and highly local. And within that, we think there's a lot of very good lending that you can do that. So that's just kind of one of the areas where we thematically align very well. So we see eye to eye. A lot of the companies that want to do this kind of see it the same way. And just couple that with the development of capital markets in the region, which, as you correctly said, I've been involved in different parts of this market, with the larger public ones and now more on the private side. And I think all of those have room to grow. And one of the areas where we really have to grow is in securitization. And that is something that will be coming in the next few years. If you kind of think of a lot of the asset-backed type lending that we want to do to fintechs and companies like that, over time, they're going to be exceptionally good candidates for securitizations, right? So will mortgages and products like that. So all of these are a series of developments that will feed in and off each other. And I think just create an exceptionally attractive opportunity for private market investing in the GCC for the foreseeable future.
You just got me thinking just now. When I was at Web Summit in Doha in February, I got talking to Facet. I'll link it in the show notes, the video that I did with them. And we talked about tokenization. I know you're not too involved on the tokenization side, but do you think there's like a lot of opportunities for private credit and tokenization?
Yes, particularly the subset of private credit that is asset-backed lending. Excuse the pun, but lends itself very well to tokenization and its use within liquidity pools in the crypto space, which, by the way, probably not coincidental at all, but there are several companies in the region that are working on these kind of solutions. It's going to be very interesting. Crypto is certainly a subset of the technological space that's going to see a lot develop, and I think it will play a very big role in asset-backed lending in a variety of places, whether it's the registration of assets, the lending against assets, lending against these pools of assets. There's a very strong overlap. I think where it will be really interesting there is not necessarily, I think the use case, frankly, is very strong. It's very natural. It's just going to be about adoption. How quickly does it adopt, and will the investors, that are looking for traditional asset-backed lending be willing to deploy that, in a large degree within crypto? I think that's yet to be seen. And also, will the current pools of liquidity within the crypto space move to these kind of assets and look to take risk? It's a likely outcome, to be honest. And I think will, again, just kind of be just beneficial for operators within the space, the kind of companies and startups and lenders in general that do rely on asset-heavy development. And this is before I was thinking about infrastructure, et cetera. There's a variety of things that could work.
Yeah, a lot of the supporters were also saying that it could be, because it's tokenized, it would lead to better liquidity for things. I don't know. Do you think that could help liquidity in this market?
I think that's a much trickier one, to be honest, than it seems. So what it doesn't do is necessarily lead to liquidity, but it allows tradeability. And tradeability and liquidity are not the same thing. Liquidity will come from, the interest of a buyer and a seller to do it. And if, I can tie it back to our asset class. So we often talk about private credit is illiquid. But, if you line up enough buyers of a loan, even if it's difficult to trade, it's theoretically liquid. With liquidity is whether there's interest for buyers and sellers of a product, not just the format. The format of tradability can make something easier to trade, and that's a plus for liquidity. The easier something it is to trade, the more likely it is to be liquid. But you could have the most liquid investment in the world. If there's, no interest to buy it and sell it, what does that matter? Public products have had this issue in recent times, right? And it's often been something that's talked about, that during periods of crisis, theaters of certain products, shy away or reduce the risk. Liquidity goes away. So it's a very tricky subject. I think liquidity itself is a beast that kind of can be studied on its own. I would reckon within this space it'll probably be interesting to know how valuable liquidity is. Whether that's the primary thing people are looking for. You'll see the space evolve in however way it does.
Close the podcast. Where do you see alpha being generated in the rest of 2026, and what are your expectations for the rest of this year with the broader market?
Well, look, I'll kind of speak specifically to what it is that I do, and to be honest, I think I see alpha exactly as everything we described here, which honestly was the same view that we had, going into the year and before. You're looking at a growing region, a growing subset of companies that are technology enabled and are dealing with a very large opportunity set. And I don't think, that is materially changed. Part of one of its benefits and what we tell clients often is that, the opportunity set is not built on being beta dependent or market driven. So I wouldn't be true to my word if I changed that view within a short period of time. But we do believe it.
So you're not looking at Truth Social or any kind of any of the antics which are going on impacting your investment decisions?
Not yet. Look, I think it's, a lot of how the developments in the region play out could have longer term impact. But from where we stand, a lot of what we do, kind of the type of investments that I mentioned are by nature very domestically focused, and are looking to address, fairly large issues. So we're not necessarily involved in the places that are most impacted. We don't currently have any investments, for example, or anything in our pipeline that's, particularly focused on either, tourism or entertainment in places that are particularly hit. And that's just because it doesn't naturally fit, kind of the mandate in what we look at kind of the core of private credit in the GCC, which I think will continue to benefit. It will do well. And like I said, I think the opportunity for what can be done in it is so early. I'll probably not to the same degree, but kind of to the point that we said earlier. It's like you're looking at the AI cycle. I'm wondering now whether something is oversaturated is way too early. There's so much work to be done, and we look like we're going to stay the course.
Sharif, tell us any projects you're working on, and also any upcoming projects you may be working on.
We are very seriously looking at, and one of the main things that we're looking at is, kind of to the point of obviously being interested in technology and what it can do, and the impact we're seeing it have on the companies we invest in, is how much of that we can deploy ourselves, with so within the process as a lender, and so how much of that how much can it help us within our due diligence process, how much it can help us within our oversight process, and within our legal and structuring process. And that's probably kind of one of the more exciting things. It's going to enable us to analyze deals faster. That's kind of always been an issue for the region, right? A lot of borrowers will often complain about the time it takes to do a deal. So those timelines, I think, will help us shrink quite a bit. I think it will allow us to do more investments because we'll be able to monitor more. And I think it will also allow us to give investors, investors within our funds, greater comfort in the type of investments that we have, to enable us to broaden our net. Once we deploy more reporting that is live, that is very well backed, that is very clearly transparent, that's potentially, blockchain enabled, as you said. A lot of these will create a lot of the confidence that we need to put in the industry. And when we do as an early participant in the space in the region see a sense of responsibility, of proving that to investors that look, these companies are very good. This is healthy investments. Just people need to see, some track record, some performance, and then just kind of the right data and disclosures. And so we're working on our side to do what we can to enable that as well. And the progress is great. I mean, we haven't had a chance. What AI has done for that has been, tremendously beneficial.
AI hasn't made us obsolete just yet. I hope, like Claude is
Not
going.
yet, but it's moving quickly.
Yeah. How can people find out about ACP?
We have, so you can find us on our website, amwalcp.com. You can reach out to me on LinkedIn. You can reach out to any member of our firm. We're a fairly small, tight-knit organization. You'll reach us very quickly, and we'd be more than happy to hear from us.
Amazing. Sharif Eid, this has been a great catch-up, and it sounds like everything is going very smoothly there. And let's catch up in a couple of months' time to see how things are. But thanks again for coming on the podcast, this time on video.
Look forward to it. Thank you so much.